Welcome back to Investing Talk Podcast.
Today, we are stripping the paint off a company that, most people think they know, but frankly, I think the market is completely misunderstanding.
Okay.
We're looking at Broadcom, ticker AVGO. And the mission for this deep dive is really to stop thinking about this as some boring legacy chip company.
Right.
The research stack we have in front of us today, it paints a picture of what is arguably the single most important AI infrastructure monopolist in the world right now.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yeah.
But, okay, hold on a second. Monopolist is a massive word to throw around in the first 30 seconds.
It is.
I mean, I know everyone is obsessed with NVIDIA. They're the poster child. But you're saying Broadcom has somehow quietly locked down the rest of the market?
Mm-hmm.
Because when I look at the stock, I see it trading at a pretty steep 51 times PE ratio. And we've got headlines everywhere about China tariffs scaring the market.
Yeah, that's the noise right now.
So the question for me today is, does the growth actually justify that premium price tag, or are we just getting swept up in the hype cycle?
It's a fair question. And, looking at that PE ratio, skepticism is healthy. But here's the tease.
Okay.
While NVIDIA is selling the gold pans to everyone, those general-purpose GPUs that get all the headlines, Broadcom has secured a lock on the custom silicon for the Magnificent Seven.
Oh, okay.
They aren't just selling chips. They are embedding themselves into the very architecture of the biggest data centers in the world.
So this is deeper.
Much deeper. If you think Amazon, Google, and Meta are going to keep building AI, you have to look at Broadcom. They are the piping, the wiring, and the custom brains that make the whole system work.
Okay, let's unpack this. We have to start with the fundamentals, because if this valuation holds water, it has to be in the numbers.
Always.
So we're looking at the data for fiscal year 2025 here. Revenue hit a record $64 billion, which is up 24% year over year. And looking at just the fourth quarter, they brought in $18 billion. That's a lot of money, obviously, but 24% growth isn't exactly hyper growth compared to some other AI names we've discussed.
Oh, right. But if you just look at the top line, you miss the real story. You have to peel back the layers.
Go on.
Broadcom is a conglomerate. They own legacy software like VMware, Symantec. But the engine driving this train, the part that matters for the future, is the AI semiconductor segment.
Okay.
In Q4 alone, that specific segment generated $6.5 billion. That is up a massive 74% year over year.
Okay, now that is hyper growth. So the legacy stuff is just chugging along, maybe dragging the average down a bit, but the AI side is exploding.
That's it.
But, market's pricing tomorrow, not yesterday.
Yeah.
What does the windshield look like? Because that growth slows down, that multiple is going to crush us.
That's where it gets really interesting. Management's forward guidance for Q1 2026, which we are right on the cusp of, is projecting total revenue at $19.1 billion. But here is the key stat that should make your ears perk up. AI revenue is expected to double year over year to $8.2 billion in that quarter alone.
Wait, pause there. If they hit $8.2 billion in AI revenue, so hang on, let me do some quick math. That means AI is becoming nearly half the business.
Exactly. It's projected to be about 43% of their total revenue. We are witnessing a structural shift in real time.
Wow.
Broadcom is morphing from a broad, diversified chip maker into a specialized AI powerhouse. And usually when companies pivot like that, it takes years, sometimes a decade.
Sure.
Broadcom is doing it in quarters.
That is a rapid transformation. But usually that kind of shift impacts margins. I'm looking at the profitability here. Adjusted EBITDA reached $43 billion for the year.
Yep.
That is a 67% margin. Honestly, for a hardware company, that is exceptionally high. That looks a lot more like a SaaS company profile than a chip manufacturer.
It does, doesn't it?
How are they keeping that much of every dollar? Usually when you make physical things, your margins are lower.
It really does look like software margins. And that margin profile is a testament to their pricing power. They aren't fighting price wars. They aren't discounting to move inventory.
Right.
They are setting the price. And the biggest companies in the world are paying it.
And they are generating cash like crazy. Free cash flow was $26.9 billion for fiscal year 2025. That gives them a lot of ammunition.
A lot.
But let's go back to that monopolist claim you made at the start. How are they defending these margins? What is the actual moat? Because usually when you have margins that fat, competition comes in to eat your lunch.
Right.
Why isn't someone else coming in and doing it cheaper?
The moat is custom silicon. This is the critical differentiator that I think a lot of retail investors miss.
Okay.
NVIDIA sells general-purpose GPUs, incredibly powerful but general. It's like buying a high-end sports car off the lot. It's fast, but it's built for everyone.
Hmm.
Broadcom works with the hyperscalers, Google, Meta, Amazon, to design bespoke chips tailored exactly to their workloads.
Oh, so it's the difference between buying a really nice suit off the rack versus getting one bespoke, tailored on Savile Row.
Precisely. And here is why that matters for the investor. Efficiency. If you are Google and you are running a specific algorithm billions of times a day, a general chip is wasteful.
Too much power draw.
It uses too much electricity, it creates too much heat. A custom chip, an ASIC or application-specific integrated circuit, is designed to do only that one thing, but do it with far less power and far more speed.
Okay, I get the efficiency argument. If I'm spending billions on electricity, I want the most efficient chip possible. But why is that a monopoly? Can't Google just hire someone else to make a custom chip next year? Or build it themselves entirely?
Not easily. And this is the lock-in aspect. Once you design your entire data center architecture, your cooling systems, your software stack, everything around that bespoke suit, you can't just switch to a different brand next year.
The switching costs are too high.
Astronomically high. It would require tearing out infrastructure and rewriting code. You are, for all intents and purposes, married to Broadcom.
And we can see this confidence in the backlog. Broadcom has a $73 billion backlog of AI orders for the next 18 months.
73 billion with a B. That is basically a year and a half of guaranteed revenue just sitting there waiting to be recognized.
It provides incredible visibility. They aren't guessing if customers will buy. The orders are already signed. That backlog is ironclad.
Wow.
It means that even if the economy wobbles, Broadcom has work to do and bills to collect for the next 6 quarters minimum.
That is a massive safety net. And it's good to see they are sharing that wealth with shareholders, too.
They are.
I see they allocated $11.1 billion to dividends, raising the payout 10% to 65 cents a share, and they extended the buyback program through the end of 2026.
So management is clearly confident.
No kidding. But let's pivot to the charts. Fundamentals are great, but price action tells us what the market is actually doing with that information.
Let's look at the setup.
As of the close on January 16, 2026, the stock was at $351.71. It recently took a bit of a hit, dipping about 4.2%.
Now, looking at the context, this seems to be macro risk-off sentiment, mostly jitters about trade tariffs, rather than something broken at Broadcom itself. But a dip is a dip. Is this a falling knife, or is this a rational pullback?
I don't think it's a falling knife at all, and that is exactly what makes this interesting. Wells Fargo just came out literally yesterday, January 19th, and upgraded AVGO to overweight.
It did. Okay.
And they slapped a price target of $430 on it.
$430. That's roughly 22% upside from where we are sitting right now.
Yeah.
It's pretty bold considering the overall market mood is a bit shaky.
It is, and their argument is that this pullback is a prime buying opportunity. They aren't just looking at the price, they're looking at the momentum of earnings revisions.
Right.
Analysts are raising their 2026 and 2027 estimates after the earnings report.
That is an important nuance. Usually estimates get revised right in earnings season, if they're drifting up weeks later.
It means consensus is scrambling to catch up to reality.
Right. It means the analysts were too conservative, and now they're realizing the numbers are going to be hotter than they thought.
Exactly. It signals a breakout could be brewing. The market is slowly waking up to the fact that their models were wrong to the downside.
However, we have to mention volatility. Tuesday, January 21st. Today might be choppy. We have these tariff jitters hanging over the sector.
For sure.
If you're looking at the screen today, you might see red. And for a lot of listeners, seeing red on a stock trading at 51x earnings is terrifying.
True, but the technical setup suggests that institutions are using these dips for accumulation. When you see a stock with this kind of fundamental backlog dip on macro noise, the smart money tends to step in.
Right.
They know the backlog is real, even if the politicians are arguing. They are buying the cash flow, not the headlines.
Well, let's check the pulse of the market then. Sentiment is a huge driver in the short term. I'm looking at our sentiment analysis here, and he gives a weighted score of positive 0.42. That's firmly in bullish territory, despite the recent drop.
It is. If you break it down, 3 out of the 5 major news items circulating are bullish. It's dominated by that Wells Fargo upgrade and by the dip calls.
So the bad news isn't about the company itself.
Not at all. The bearish news is strictly macro politics, tariffs. It's not about Broadcom's execution or their chips failing. No one is saying the product is bad. They are just worried about the trade war.
There's one piece of insider sentiment I want to highlight because it blew my mind. The CEO, Hock Tan, His compensation package.
Oh, this is the ultimate tell.
Right. We talk about skin in the game a lot, but this is on another level.
Hock Tan is legendary for being shareholder aligned. He doesn't get paid for effort, he gets paid for results.
So tell us about the 2030 target.
Okay, so Hock Tan's compensation package for 2030 is tied to hitting $120 billion in AI revenue. Not total revenue, specifically AI
The
revenue.
120 billion, just to contextualize that for the listener, what are they doing right now?
Currently, AI revenue is running at an annualized rate of about $20 billion.
So the CEO is betting his entire massive paycheck on growing this specific segment 6x over the next 4 or 5 years.
Exactly. He is putting his money where his mouth is. You don't sign up for a target like that unless you see a clear path to get there.
True.
It aligns his incentives perfectly with that long-term monopolist thesis. If he wins, shareholders win big. It suggests he knows something about the demand curve that the market hasn't fully priced in yet.
And Wall Street seems to agree. Consensus is a strong buy, with a mean target suggesting about 29% upside.
Yeah.
Are there any specific catalysts we should be watching for? Because stocks don't just go up in a vacuum. We need a spark.
Aside from the earnings, there is speculation about an expanded partnership with Alphabet Google. We know Google is pushing hard on their TPUs.
Tensor processing units, right?
Broadcom is the partner there. If that partnership expands, or if we see more synergies from the VMware acquisition finally kicking in on the software side, those are massive levers they can pull.
Okay, I have to play devil's advocate now. We've painted a rosy picture. But my job is to look at the risks.
Let's do it.
We have to talk about the bear case. If I buy this at $350, how do I lose money? Because at this valuation, if things go wrong, they go wrong fast.
Let's hear it.
Risk number 1, geopolitics. We have reports of a China cybersecurity ban on Broadcom software. And generally, the tariff threats from the Trump administration are ramping up.
Right.
We know the chip sector is incredibly sensitive to this. If China shuts the door, that revenue evaporates. We've seen this movie before.
It is sensitive, I grant you that, but we have to look at exposure. Where is the growth coming from?
The AI revenue?
The AI revenue. And who is buying that? The U.S. hyperscalers, Amazon, Google, Microsoft. They are largely insulated from China trade issues.
So the data centers are here.
These chips are going into data centers in Virginia, Oregon, and Texas. The China ban you mentioned affects a specific slice of their software business, but it doesn't touch the core growth engine, which is the custom AI silicon.
So you're saying the growth engine is domestic, so the trade war is just noise.
Effectively, yes. It hurts sentiment, and it might trim a few percentage points off the legacy business, but it shouldn't hurt the cash flow of the AI division. The people buying Broadcom's best stuff are not in Beijing. They are in Silicon Valley and Seattle.
Fair point. But what about risk number 2, valuation? You cannot ignore a PE of 51.58x. That is steep.
It is.
And on top of that, management admitted gross margins are expected to drop 100 basis points in Q1 2026. If I'm paying a premium multiple, I don't want to see margins compressing.
I see that differently. The margin drop is a mix shift, not a loss of efficiency, and this is a concept that is really important to grasp for this specific company.
Okay, what do you mean by mix shift? Explain that like I'm 5. Why is a margin drop okay?
Okay, imagine you sell software. It costs almost nothing to copy and sell, so your margins are huge, like 90%. Yeah. But now you start selling Ferraris. Ferraris cost money to build metal, engines, leather, so your percentage margin drops to maybe 60%. But you are selling a Ferrari for $300,000 instead of software for $100.
So the percentage goes down, but the actual pile of cash gets way, way bigger.
Exactly. AI chips cost more to make than their legacy software products, so the percentage margin is slightly lower. But, and this is huge, they bring in way more absolute profit dollars.
Right.
Would you rather have a 70% margin on a $10 product or a 60% margin on a $100 product? You take the absolute dollars every time.
You can't spend percentages.
You can't spend percentages at the grocery store. You spend dollars.
Okay, so you're saying we are trading a percentage point of margin for a flood of cash.
Yeah.
That makes sense. It's a volume of profit play.
Precisely. And regarding the PE ratio,
Yeah.
yes, 51x is high for a legacy chip maker. But for a company growing revenue at 28% with 67% EBITDA margins,
It's a different beast.
it commands a premium. It's priced for perfection, sure, but they are delivering perfection.
And I guess that $73 billion backlog is the safety net we talked about. It's hard to see a sudden revenue drop-off when you are sold out for 18 months.
Precisely. It puts a floor under the stock. Even if the economy slows down, those data center contracts are signed. The hyperscalers are in an arms race. They cannot afford to stop buying.
They'll lose to their competitor.
Exactly. And Broadcom benefits from that paranoia.
All right, let's move to the final verdict. We've looked at the growth, the charts, the sentiment, and the risks. What is your score for Broadcom right now?
I am assigning a bullish score of 8.5 out of 10.
8.5? That is confident. That puts it right near the top of our watch list.
The key drivers are undeniable. You have structural AI tailwinds that are not going away. You have the moat of custom silicon, which is stickier than people realize.
And the backlog.
And you have that massive backlog providing visibility that almost no other company in the S&P 500 has right now.
So where do they lose points? 1 out of 10.
Purely on the valuation and the near-term macro noise. The tariff headlines will make the stock volatile in the short term, and paying 51x earnings always carries some risk.
Of course.
If the whole market goes down, Broadcom will go down with it simply because it's expensive.
So what is the elevator pitch for the investor listening right now?
Broadcom is the pick and shovel play for the Magnificent Seven's AI build-out. They are indispensable. If you believe Google and Meta are going to keep building AI data centers, you have to believe in Broadcom. Expect 25% plus earnings growth through 2027.
So how do we structure this trade?
This is a multi-year hold. This isn't a quick flip. You are buying a compounder.
And tactically.
Yeah.
Because we are seeing red on the screen today. Do we jump in right now?
Use this current risk-off dip.
Okay.
If you see it below $340, that is your accumulation zone ahead of the Q1 earnings on March 4th, 2026.
So don't chase it.
Don't chase it if it spikes. Let the volatility come to you.
And
Initial upside to $380 or $390 as the tariff noise clears. Medium term, I agree with Wells Fargo at $430. But long term, if we look out to 2028 and beyond, if Hock-Tan hits his metrics, we are looking at a $500 plus stock.
That is a compelling roadmap. Give us the final word.
For long-term investors, the volatility you see this week is just noise. The AI backlog is the signal. Don't let the headlines shake you out of a structural winner.
Make sure to subscribe, like, and comment to catch our next analysis. Thanks for listening to Investing Talk Podcast.